name is Yasmin. I'm the Executive Director for the Middle East Venture Capital Association. And at our panel today, we're going to be getting different perceptions from the different stakeholders within the crypto space. Gentlemen, if I could ask you to just take a minute and introduce yourselves, please.
Sure. Good morning, everyone. I'm Marco Massucco. I'm a Managing Director at First Abu Dhabi Bank, the largest bank in UAE and one of the leading banks in the Middle East, where I run our financial institution sales business. My interest in this space is dual. On one end, I see the potential of blockchain to become an integral part of the infrastructure underlying financial markets. One day, we're not clearly there yet, but I can tell you that after 20 years in markets, I certainly see the appeal of a technology that allows better transparency, easier settlements, better collateral management, and therefore better risk management. That's one side. On the other end, running a client business in this part of the world, we cover most institutional investors, family offices, CIOs, and certainly digital assets are on their map, have been for some time, and that's the perspective I'd like to bring to the panel today.
Hi, I'm Brett Tejpal from Coinbase. By way of introduction, I spent 10 years at JP Morgan and 17 years at Barclays before joining Coinbase 2.5 years ago. I mention that because during these turbulent times, I think it's important to have someone who understands what regulated financial services are about and what's good and what's not accepted. I'm here to represent the institutional business together with Greg Tusar, who runs product. We're responsible for a business that represents 55% of all assets on platform and 70% of all the trading volume. Coinbase is probably best known for the fact that it services retail, but the institutional business is a small but growing part of that picture. At Coinbase, we're a publicly listed NASDAQ company. We've got 100 million verified users. And what separates us from most others is that early in our founding, Brian Armstrong opted in to be regulated. And so when I think about what we do well, we do simple things well. So the first of which is safeguarding assets. We operate at scale as a qualified custodian under US law. 2, we give best execution and price discovery without conflicts. So we have an absence of conflicts is probably the best way to say it. And 3, we're transparent. We're transparent with how we segregate assets. We're transparent with our financials. We just reported our Q3 results, so you can have a look there. But that's not really what separates us in the institutional business. There's really the quality of who our clients are. So I'm delighted to be on stage with everyone here, in particular BlackRock, the world's largest asset manager, who we announced a partnership with this summer, also partnerships with Google. 2 more fun facts. By my estimation, the largest 100 hedge funds in the world, about 1 out of 4, a quarter of them have activated in crypto. Of those that have activated, all of them are on Coinbase's platform. So I'll end this by saying it's really about the quality of our institutional clients that separates us. No matter if you're a big tech company, a sovereign wealth fund, a public corporate, a private corporate, a hedge fund, a systematic trader, a crypto-first firm, you've chosen Coinbase.
Good afternoon, everybody. My name is Alexander Lipton. I am a global head of research and development at the Abu Dhabi Investment Authority right here, not far from this building. By way of my background, I got a PhD in pure mathematics, and for a short period of time I worked in space exploration and then in thermonuclear fusion at MIT and places like that. I was a professor at the University of Illinois, and then eventually I switched to investment banking and became a quant. So I started at Bank of America. I started at Bankers Trust, and then moved around the food chain, so to speak, and ended up as a co-head of the global quantitative group at Bank of America. After that, I co-founded my own company, which is called Sila, and still going strong in Portland, Oregon. And in the end of 2021, I joined IDEA in this current capacity, and I have a variety of interests, but crypto space and more specifically distributed ledger technology is one of the things which I'm very interested in. I wrote a book about that, and with some colleagues at IDEA, we are actively exploring how this technology can change the way things are done on a world stage. So that's why I'm here in this panel today. Thank you.
Great, and I'm Robbie Michnik. I won't even bother with my bio after Professor Lipton. That's quite a career. I'm the head of digital assets at BlackRock. Most people know BlackRock as the world's largest asset manager, but we are also the provider of the Aladdin investment management technology system, which is used by the many of the world's largest buy-side firms, including, of course, BlackRock. So I'm our head of digital assets. That means our team focuses across the spectrum of this technology area and asset class, everything from permission blockchain to tokenized financial assets to stable coins, and of course, crypto.
Thank you. Marco, I just want to start with you from the perspective of FAB. How do MENA institutions think about entering new asset classes, and is there importance for local presence?
Great question. The broadening of the range of assets investors look at is nothing new. I'm dating myself a little here, but it feels like yesterday that we were looking at how to add commodities, for instance, to the picture. And Brett would relate to that because he was running that business at Barclays when I was at Merrill Lynch. And the key issue at the time was how to get exposures for the investors without the associated issues with custody of a real asset, which are topics that now we find ourselves again discussing today in this brave new digital space. So that's not new. When it comes to this part of the world, and specifically the UAE has done a tremendous job over the past couple of years in really becoming the place to be for anyone active in this space. But I can tell you, and I've been here for the last decade, that investors have been looking at digital assets way before that. Small anecdote. I came into contact for the first time with Bitcoin back in 2015 when a miner was pitching a prominent family office here in Abu Dhabi. Great insight. That's where I started learning about blockchain. I probably understood half of it, and even worse, Bitcoin at the time was $400, and I did not necessarily follow up on the hint, but that I only have myself to blame for that. But that tells you that institutional investors in the parts of the world have been looking at this for quite some time. Fast forward to today, what we notice is a change in how they look at the asset class. It's not anymore a foreign object from which uncorrelated exceptional returns are expected. Is now seen using a definition that is not mine, but that I sort of embrace as liquid venture capital. Is leaving Bitcoin aside, but the other projects seems to share many features of venture capital, such as the lack for many of cash flows, which leads to more difficult the challenges of valuation. They are ultra long duration assets that therefore are affected, as we have seen, by the changes in the interest rate environment we're going through. But they're liquid, and there are pros and cons with it. Obviously, the ease of investing and exiting is appreciated. Of course, that also brought probably more more volatility. So I find that the investors we talk to have this now clearly mapped where this asset class could sit, probably next to tech, growth, equity, and venture capital, and highly correlated as we've seen. Also, we noticed that there is a better understanding of the various ways to possibly approach this space and tech exposure, not just through listed tokens, but also through private equity or through some of the non-directional strategies that obviously in these markets have done very well. And yes, that's what we're seeing. You're asking me about local presence. Well, I think certainly it's relevant to be here, and given the platform that has been made available to all the business active in this space, I would say it's a shame not to be here. So we are great ambassador of this place, both in terms of doing business, but also from a personal life perspective.
I couldn't agree with you more. Brett, can you tell us the importance of institutional for you as Coinbase?
Sure. So let me start big picture with the fact that Brian founded Coinbase with the mission of bringing economic freedom to the world. It's important because it binds the whole firm together. Our near-term goal is to create 1 billion users in crypto. We're on our way. Internationally, this is a really important region. We've seen crypto adoption trends in MENA surpassing those of elsewhere. I think Coinbase at present is heavily indexed to the US market and is looking to expand, I think, internationally. I'll never forget, actually, the opening of this session where His Excellency invited us to the capital of capital. I mean, what a way to open a conference. And so when I think about the importance of helping capital find its way into crypto, what better place than here to focus on. When I think about broad-based crypto adoption, it includes not just retail participation, but has to include the broader participation of institutions of all types. So whether it be challenger banks, payment platforms, micropayments, peer-to-peer, the whole crypto native set, but also asset management, pension, endowment, sovereign wealth funds, et cetera, all of whom, by the way, are active on our platform. So when I think about accomplishing the mission, which is really what we're here to do, is the combination of retail scaling plus institutional capital being deployed in this space. What I'm excited about is that when I first joined Coinbase, there seemed to be institutional interest was really fixated on onboarding to the platform and being able to deploy capital in a speculative fashion to try and earn a rate of return. So there's quite a lot of people who just wanted to buy Bitcoin or ETH. What's happened in the past year to 18 months, and as evidenced by some of the things you saw on the entrance and the way in, is the exploration of use cases beyond just putting capital at risk to earn a return. So I would reference the use of stablecoin in particular. And so there's a whole swath of use cases beyond speculative risk, and capital at risk that are driving institutional exploration. So if I were to think about why some of the largest asset managers in the world and banks and traditional participants are thinking about their crypto strategy, it's because they believe in the transformative power, the disruptive power of crypto to financial services. So that's how I sort of encapsulate the importance, the mission critical importance of institutional capital finding its way into the space.
And you talked about the growth in MENA. Brett, where do you see the majority of growth coming from over the next 5 years?
Well, growth internationally is important for Coinbase. Specific to MENA?
No, I'm saying you had referred to MENA, but where do you see the majority of growth, or what part of the world do you see the majority of growth coming in the next 5 years?
I feel like the U.S. is a core market. It's going to continue to build, but what's interesting is most of the corporations, the institutions, again, sovereign wealth, asset managers, pensions of all types, corporates of all types, everyone's a multinational corporation, right? And so, yes, we'll have targeted deployments of retail operations elsewhere, but in a similar way to financial services, there are core operating centers, including here. And so with institutional adoption, I think you'll have just massive growth. My guess is this region is poised to be actually a leader in the space on adoption, as evidenced by what I see. And what's different about what I see here is there's a lot of geographies, countries that are giving a little bit of like, hey, we want to be there too. What I sense in my few days here is that there's a lot. This is an execution-focused place where there's real blockchain cases being put to use here with real intent and with urgency. And so I would put this region, I think, at the top of my expectation for adoption.
Fantastic, thank you. Alex, you represent one of the largest sovereign wealth funds in the world. Can you tell us how sovereign wealth funds are going to be incorporating digital assets into their investment thesis?
Thank you, Yasmin, for this very interesting question. I want to make clear that I don't want to represent any of the views as attributable to ideas, so it would be more like my own thinking about how a sovereign wealth fund has to address the issues associated with blockchain technology, distributed ledgers, cryptos, and things like that. So from my perspective, there are several areas where these large institutional holders of assets should be thinking. So one is definitely central bank digital currencies, and as a substitute for those stable coins. That's one area where I'm personally extremely excited. It also makes sense for smaller countries to make sure that they are really mastering this technology, because otherwise there is a real danger that their own currencies would be superseded by digitized version of much larger currencies. This is particularly acute here in this area because we have ginormous neighbors to the east, India and China. And China in particular is very energetic, not to say aggressive, by way of developing its own digital yuan. And in conjunction with the Belt and Road Initiative, it can actually result in yuan kind of flooding the entire part of the world, so which might or might not be desirable. So that is a very big issue. The other, even bigger issue in many respects is tokenization of liquid assets. In my mind, a sovereign wealth fund, by its very nature, should be more interested in liquid assets because everybody can access liquid assets by definition, and then tokenization of those assets can actually bring in much needed liquidity and participation of the population as a whole in this type of activities. And finally, of course, this mastering of these technologies can also bring massive benefits as far as an organization itself is concerned, the way it conducts trading, the way it conducts its own operations and things like that. Having said that, I started to think lately that perhaps this blockchain technology in the form of unpermissioned public blockchain has not lived to its promise in a very specific way, not by way of kind of breaking up and things like that. The layer 1 protocols like Bitcoin have not been breached despite, of course, a gazillion of trials. It's more like there is no decentralized access to decentralized protocols, and that is a really, really serious issue. So I can see two possibilities in this regard. Either really proliferation of decentralized finance in the form of automated market-making facilities, or else design of a much simpler blockchains like Binance blockchain, for example, without endorsing or disparaging it, just by saying that it's a much simpler protocol with very few validation nodes and things like that. And that is probably what is needed to actually see central bank digital currencies, especially cross-border applications, which is very, very important for this part of the world, given how many expats live here and send their money to anywhere from the Philippines to India to Bangladesh and other places like that. So that's where I see the real bang for the buck. So in other words, central bank digital currency, tokenization, and real application for the financial services. I would personally also very much like to see physical banknotes transformed into a hybrid physical / digital banknotes. I can figure out how to do it one way, from physical to digital. I'm still struggling a little bit with digital to physical. So that can be that's a subject of an interesting research to be done and has not been done yet. Finally, to finish, I would say that application of NFTs, especially hybrid NFTs, to tracking supply chain, to tracking illiquid investments and things of that nature also seem to be very, very promising. So to finish my statement, I would say we need a simpler layer 1 protocol which is accessible in a decentralized fashion and cheap enough to maintain central bank digital currency and transaction in the tune of at least 100,000 a second. So here I would stop. I think promises are big. Delivery remains to be seen. Thank you.
Well, I don't think there's a better person to run that research than you. Robbie, crypto's taken a hit this past year. Can you tell us if this downturn's affected the institutional demand for your clients?
Well, I think BlackRock takes a long-term view of these things. We're focused on the long-term disruptive potential here. That's why we weren't rushing in 2017 in the third crypto cycle. We weren't trying to be a first mover. I think that's true for a lot of our clients as well. They're taking a long view and a measured approach. What I do think you're starting to see is some reconsideration of questions like just how many crypto assets need to exist in the first place? How many have real economic usefulness? How many different types of projects and protocols and companies, and what's the breadth of adventures that investors are willing to participate in this space, which has brought the thinking back to what I think is going to be a little bit narrower focus for a lot of institutions going forward. I mean, as a lot of institutions continue to grapple with the question of things like how they might allocate to Bitcoin in particular, I think that continues here. But what's often underestimated on that front is outside of hedge funds, institutions of all other stripes, whether they be asset managers or banks or sovereigns, endowments, pension funds, have very different needs in terms of access to crypto than hedge funds do. Hedge funds, of course, being the early adopters in the institutional space. And so that means solving things like the fact it's a 24/7, 365 market that settles in real time. And absent a bespoke solution actually requires pre-funding. Connecting to fragmented liquidity venues is a real challenge. Navigating how custody works between hot wallets and cold wallets, and getting familiar with a novel ecosystem of providers. All those things are real hurdles. In many cases, they've caused institutions to divert their capital and attention away from direct exposure, which is infeasible, to some alternative exposure vehicles, whether they be direct corporates or what else, sometimes with bad outcomes. But what we're starting to see is slowly but surely those frictions breaking down. So if you think about the two things that BlackRock did over the summer that got a lot of press attention, but one was Aladdin, a decision to support crypto in Aladdin by integrating with Coinbase to make it basically just like any other asset class in Aladdin. And the second being our Bitcoin exposure vehicle, which is again just meant to solve those frictions associated with access by being able to provide a turnkey, efficient exposure structure. So that demand continues to be the genesis of what we do in this space.
That's fantastic. Thank you. You all made some interesting points, and I'm excited to see what unfolds in this space in the next few months. Thank you to the audience for taking your time, and everybody have a wonderful day.
Thank you.
Thank you.